Hello everyone, I am Shaumadi Patro from Techno India University, and today I am going to give one presentation, and my presentation topic is mental accounting. So today I will start my presentation with some example. You can say it may be a case study. So here we have two conditions. Okay, the first conditions, here is a question that you bought a theater ticket for rupees 100. At the theater entrance you discovered that you lost the ticket. Now for these conditions the question is, would you buy another ticket for rupees 100? And then we have a second condition. Okay, the condition is on you way to the theater to see a play for which ticket cost rupees 100. You discovered that you lost rupees 100 on your way. Now for this condition the question is, would you buy the ticket for rupees 100? So here the answer is, the people are willing to pay rupees 100 for the lost rupees 100 than to pay rupees 100 for the lost ticket. So the fact is that people are willing to pay the money for the money that they have lost already, but they don't want to pay the money for the lost ticket. The ticket they have already lost, they had already lost. For that lost ticket they don't want to pay the money. So this is the fact. And then we have second case studies. In this case one, we have rupees 1 lakh in our savings account in the bank. And in case 2, we get a rupees 1 lakh in bonus. Okay, so the question is, if you need to spend rupees 1 lakh for a new phone, which rupees 1 lakh would you use? So the savings, here the answer is given that the people think that savings are untouchable. Therefore, one buys new phone using bonus, as bonus is to enjoy. Here my topic is mental accounting. So here the mental accounting is working like this, that the people are thinking that the salary is, they are getting the salary. So it's not, so this salary you cannot use to buy or to enjoy or to or to use something for this phone, but you can use this bonus to buy this phone to enjoy. This is the people thinking. Okay, and now here are some here a real example that we hesitate to add a tip to Zomato delivery person, but we usually easily give tip away while we are in restaurants. So people tend to view the same amount of money differently based on factors like its source, use, needs, etc. The rationale behind this selection of choices is explained by the consumer. So the thing is that while we are ordering some food through apps, through whatever, we are not giving them to that carrying cost. We are not giving them to that. We are not willing to paying them to that carrying cost, to that distance traveling cost. But when we are going to the any restaurants, okay, and after payming the bill, they are giving me that bill. After then we are paying that tips to them. So as we are paying tips to a restaurant, so why we cannot pay that tips to the when we are buying that food through online through. So this is the mental thing is creating, this is working to the people. Okay, now the main slide. What is mental accounting? Actually, what mental accounting is? So here it is written that mental accounting is a set of cognitive operations used by individuals and households to organize, evaluate and keep track of financial activities. It is one of the heuristics that sort mental to judgment. So now this is the mental accounting is actually. Now it was proposed by Richard Thaler, and he has the Nobel Prize for his contribution to economic science. Now mental accounting causes people to separate their money into separate accounts, often based on specific criteria such as source of money and the intent for each amount. So the thing is that People are getting salary. After getting salary, they are making some planning to invest something. You mean, I mean, you know that after, suppose there's his or her salary is 10,000. So from 10,000, he or she is planning to make so many things from this salary. So this is the thing here it is written. Okay. Now the components of mental accounting. Now account assignment, many people normally places their money in different accounts, broadly categories into expenditure, wealth and income. Yes, that I have already tell. Okay. Closer, it is natural to close to the account when the term is consumed. Evaluation, it is all over written over there. Okay. Now mental accounting bias, how it hurts. Okay. Now the thing is, it is mental accounting bias due to which we throw our unexpected gains, tax, bonuses, birthday money, lottery winnings. Now we tend to keep too much money in cash emergency fund rather investing. Now we tend to avoid risks with our sudden unexpected gains. Now we push away important purchase from one account. Now the overcoming mental accounting. Here are some points. The first point is, if investors create all the income, expenditure and wealth irrespective of their source and purposes. Now the second point is, investors can avoid the effect of mental accounting bias if they design and have a proper asset. Now the third point is, money is fungible. Get a fungible concept in mind. Now the fourth point is, be careful with the budget. We tend to overspend the leftover, rather savings excess budget for future investment or expenditure. Okay, that's all. Thank you.